Have you ever looked at your 401k statement and wished you could invest in something other than stocks and bonds? In this video, I'm going to share the exact blueprint for how you can take your retirement account and start building wealth by investing in real estate. But before we jump in, make sure to hit that like button, subscribe to the channel, and click the notification bell so you don't miss the next video. For years, I worked a corporate job, and I felt the frustration of having my savings locked away in a 401k account. And like many of you, I thought my retirement funds could only be used to hold stocks, bonds, and mutual funds. But then I figured out how to use tax-advantaged retirement accounts to their full potential. And while using an IRA to buy real estate is an established strategy, it does have a very specific set of rules. Following these rules is the key to making it work. Ignoring them can cause serious financial headaches. So get ready to take some notes, because by the end of this video, you'll have a clear, actionable roadmap on how to invest in real estate using your retirement account. We're going to walk through the critical steps, including setting up the right kind of account, funding it, using it to invest in real estate, and most importantly, managing it correctly to maintain those tax advantages and keep you out of trouble with the IRS. Okay, first things first. You can't use the standard IRA or 401k you have with a typical brokerage firm to invest in real estate. If you called them up and asked, they would probably tell you it can't be done. And for their type of account, they'd be right. Most traditional and Roth IRAs are limited to stocks, bonds, and mutual funds. The tool that you need is called a self-directed IRA, or SDIRA. A SDIRA functions much like a regular IRA, but with one crucial difference. It allows you to invest in a much broader range of alternative assets, including real estate, private companies, and even precious metals. In other words, it gives you direct control over your investment choices. With a SDIRA, you're the one making the decisions on where your money is invested. To do this, you need to work with a specialized company called a custodian that manages these self-directed accounts. This custodian does not provide investment advice. Their role is simply to hold the assets, process the transactions that you direct, and handle all the necessary IRS reporting. They ensure that you're following the rules, which is why choosing a reputable custodian with experience in real estate is your first important step. Step 1, setting up and funding your account. Now let's get a couple of things clear before we move on. Most people can't roll over a 401k with a current employer to a self-directed IRA, unless their plan specifically allows for what's called in-service rollovers. This typically applies after age 59 and a half or meeting some other criteria. But there are no restrictions on rolling over a 401k with a prior employer. So if you have a 401k plan from a company that you're no longer working for, you can easily move the funds into a self-directed IRA. The same is also true if you have a traditional or Roth IRA that is not employer-sponsored. Okay, so your first step is to open a SDIRA with a custodian that understands real estate. You'll find companies like Directed Trust Company, Equity Trust Company, Strata Trust Company, or many others. They each have different fee structures and services, so make sure to do your research. You'll want to look for a custodian with a solid reputation, transparent fees, and a good track record with real estate deals. Once the account is open, then you need to fund it. And pay close attention here, because this is where you can easily make a mistake that leads to unnecessary taxes. You do not simply withdraw money from your existing IRA and deposit it into a new one. That would be called a taxable distribution. Instead, you'll use either a direct transfer or a rollover. A trustee-to-trustee transfer is the simplest method. That's where the funds move directly from your old IRA custodian to your new SDIRA custodian without you ever touching the money. The other option is a rollover, where you receive a check from an old 401k or an IRA. If you do, you have a strict 60-day window to deposit that money into your new SDIRA account. The direct transfer is the easiest and safest way to avoid any tax issues, and it's the one that I would recommend. Just work with the IRA custodian and they'll walk you through the process. Remember, you can fund your SDIRA from an existing non-employer-sponsored IRA, a 401k from a previous employer, and you can continue making your normal annual contributions. Step 2, selecting your investment property. All right, now for the exciting part, choosing an investment. With a Sedera, your options are pretty broad. You can buy a property directly, for example, single-family homes, duplexes, or even apartment buildings. Or if you want to invest passively and let somebody else do the work, you can invest in private placements like apartment syndications. But if you do invest directly, there is one very important rule. The property must be strictly for investment purposes. If you buy a property directly, you cannot receive any personal benefit from it. This is a core IRS concept called self-dealing, which I'll touch a bit on later. And violating this rule has serious tax consequences. For example, you can't buy a beach house with your IRA and use it for family vacations. You can't buy a condo for your child to live in during college. You can't even buy a fixer-upper and do the repairs yourself to save money, because that's considered providing a service to your IRA. The IRS is very clear. The investment must be for the sole benefit of your retirement account. Think of it like a separate entity and treat it that way. Any transaction that benefits you or a disqualified person is not allowed. If you want more information on the specific rules, your Sedera custodian will know all the ins and outs and be able to answer any of your questions. All right, we're about to get into the most critical part of this whole process, the rules that you really need to understand. If you're finding this helpful and want to continue learning how to take control of your financial future, please hit that like and subscribe button. It helps the channel out and make sure you won't miss what's coming up. Step 3, the nuts and bolts of the purchase. Okay, so you've found the right real estate investment. Now, how do you actually buy it? This is where the separation between you and your IRA has to be crystal clear. Your IRA, not you, is the buyer. Every legal document, from the offer to the title, must be in the name of the IRA. Once again, the Sedera custodian will guide you through this process. They'll also review and sign the closing documents on behalf of your IRA. This separation applies to every dollar involved. The earnest money, the down payment, and all the closing costs must come directly from your Sedera. You can't write a personal check to cover a last-minute fee. And it works both ways. All income from the property, like rent checks, must be paid to the IRA and directly deposited into your IRA account. Mixing personal and IRA funds is a prohibited transaction, and it's a mistake that you'll want to avoid. In the eyes of the IRS, your IRA is a completely separate financial entity, and it must be treated that way. Step 4, the golden rules, avoiding prohibited transactions. I can't stress this enough. Understanding and avoiding prohibited transactions is the key to making this strategy work without running into trouble. One mistake can disqualify the entire IRA, which could make the full account balance immediately taxable and lead to significant penalties. So let's get specific. The rules centered around what the IRS calls disqualified persons. This list includes you, your spouse, your parents, your children, your grandchildren, and any business that you or these relatives control. Here are the most common prohibited transactions to avoid. Number 1, self-dealing. You can't sell the property you already own to your IRA. Your IRA also can't sell a property to you or any other disqualified person. Number 2, personal use. As we already covered, you can't live in, vacation at, or use the property for any personal reasons. Neither can any disqualified person. Number 3, providing goods or services. You cannot personally perform work on the property. If you're a contractor, you can't fix a leaky faucet. If you're a real estate agent, you can't take a commission on the sale. All management and maintenance must be handled by independent third-party professionals, paid with funds from the IRA. Number 4, mixing funds. Every single expense, property taxes, insurance, repairs, HOA fees, must be paid from the IRA, and all income must go directly into the IRA. Number 5, extension of credit. You can't personally guarantee a loan for the property within your IRA. The guiding principle is simple. Your IRA has to function as an arm's-length investor. It must operate completely independently of you. Step 5, financing and managing your investment. What if you don't have enough cash in your IRA for an all-cash purchase? you can get a loan, but it has to be a specific type called a non-recourse loan. A typical mortgage is a recourse loan, meaning if you default, the lender can come after your personal assets. This requires a personal guarantee, which we just learned is a prohibited transaction. A non-recourse loan, however, is secured only by the property itself. If your IRA defaults, the lender takes the property, but they can't touch the assets in your IRA or your personal assets. Now, because this is riskier for lenders, you should expect a larger down payment, something in the 30 to 40% range, and a higher interest rate. It's also important to keep in mind that using a loan introduces a tax consideration. When your IRA uses debt to finance a property, some of the income might be subject to what's called unrelated business income tax, or UBIT. Essentially, the IRS collects tax on the profits generated by the borrowed money. This is an area where things can get a little bit complicated, so it's crucial to talk with a tax advisor before you consider using financing in your IRA. Finally, a reminder on management. You must hire a third-party property manager, and their fees have to be paid by the IRA. This maintains that critical arm's length separation and keeps you in compliance. And remember, while your IRA grows tax-deferred, you won't get to take some of the standard real estate deductions, like depreciation and mortgage interest, on your personal income tax return. All other costs like maintenance, insurance, and appraisals also come directly from the IRA, which will affect your returns. But that's the trade-off for tax advantage growth. So let's recap the process. To use your IRA to buy real estate, you need to 1. Open a self-directed IRA with a custodian that has experience with real estate. 2. Choose an investment and understand that it can't be for personal use. 3. Make the investment in the IRA's name with all funds flowing out of and back into the IRA. 4. Follow the prohibited transaction rules and avoid self-dealing at all times. And 5. If you need financing, use a non-recourse loan and always hire third parties for management and repairs. Yes, there are some rules, but they are very manageable once you understand them. Taking control of your retirement funds to invest in tangible, income-producing real estate is an incredibly powerful way to build long-term wealth. Doing so means you're not limited to the ups and downs of the stock market, and you can diversify into an asset class that has been a cornerstone of wealth creation for generations. If you got any value out of this video, do me a favor and like, subscribe, and hit that notification bell so you don't miss the next video. I'd also love to hear your thoughts and answer any questions you might have, so make sure to leave them in the comments below. And as always, I'll see you in the next one.